gold is really inversely correlated with the dollar and real interest rates, and that explains a lot of gold's price action. When we look at Bitcoin, we don't see a similar, correlation to those types of macroeconomic drivers. I think Bitcoin is really driven more by So we basically track about 50 different macroeconomic data points, and we've been doing this for years, and that sort of builds into our sort of investing framework.
Michael Nadeau, founder of the DeFi Report, delivers clear market insights and on-chain analysis for investors navigating crypto and Web3.
Blending equity-style research with a background in finance, he makes complex DeFi trends accessible through actionable frameworks and educational content.
Countries that have stronger real interest rates tend to be a magnet for capital. And so we can kind of apply that type of framework to layer one. And so, you would kind of assess that similarly, where you have things like, I think of in the future, what should drive those flows is that real on-chain yield, which is expressed through the fundamentals similar to like a country. Yeah, so the real on-chain yield is just simply the amount of. So I used to kind of have this view as well of like meme coins are a joke, and they're sort of like kept making it harder on people like me that are focused on fundamentals and valuation and try to bring legitimacy to this industry. I sort of changed my mind this cycle.
Hey guys, welcome back to Less Noise, More Signal. Today I am joined by Michael Nadeau, and you're a fellow from the DeFi Report, something which I really like. It's this research boutique, and you've been putting out a many good research report that I've been devouring. And so I felt like I have to bring you on because you provide a lot of original content as well. And so happy to have you here.
Yeah, it's great to be here. Thanks for the kind words. Yeah, so founder of the DeFi Report, we've been around for 4+ years now, and really started up. I got into crypto when I was actually working at MIT's endowment, and I used to work in commercial real estate doing accounting and finance, and got exposed to a lot of really interesting technologies at MIT. And that was really where the crypto journey began, because there were so many intellectually curious people, and it was sort of acceptable to talk about crypto back in 2016, 2017. And the challenge that I was running into as I was getting deeper into it was just like having data and having a framework and understanding fundamentals, and really doing like truth-seeking work to really figure out like what's going on chain. And so that's really how the DeFi Report started, me solving my own problems as an investor and doing that through on-chain data, fundamental analysis. And so we share a lot of that work for free through our newsletter. And we also service clients. We do have a TDR Pro, which is our paid monthly service as well. And happy to come on and talk about on-chain data, crypto, fundamentals. I think it'll be a fun conversation.
To start off, I'd like to just kind of set the stage in terms of when you see these assets, what type of assets are they for you? And then also, do you differentiate between Bitcoin and other cryptos?
Yeah, for sure. So, I think a lot of people, we're sort of lazy in how we think about things. We always want to use analogies, right? We always want to take an asset, find sort of an easy way to explain that, and then apply like a similar framework to valuation and to understanding that thing. I think that's a mistake, with crypto, because these things are fundamentally different. And so I think a real sort of first principles type analysis needs to come into play here. In terms of like separating Bitcoin from everything else, I do sort of see the crypto world through that lens. I kind of view Bitcoin as like a special snowflake. It doesn't have a yield. And so how do you value that thing? I think most people are sort of comparing that to gold. And it does have a lot of the similar features that gold does. And it does seem to trade on sort of some macroeconomic drivers. However, it really doesn't have a very strong correlation to gold. And it really doesn't. Gold is really inversely correlated with the dollar and real interest rates. And that explains a lot of gold's price action. When we look at Bitcoin, we don't see a similar, correlation to those types of macroeconomic drivers. I think Bitcoin is really driven more by adoption cycles, tech adoption generally. Also, just kind of the reflexivity of how on-chain economics work. So that's kind of how I think of Bitcoin. I think it's its own thing. It's separate from how you would think about other layer one networks, smart contract networks that do have a yield. And we can sort of apply a framework around gold using the hard money, but it really doesn't trade on the same core fundamentals that gold does.
I'd like to get into this, but maybe first off, one more question in terms of like, even though Bitcoin seems to be sort of distinct from the other assets in that sense, or at least it's like the go-to assets in the crypto space, there is also still some great correlation by all the other assets to Bitcoin, meaning that if Bitcoin sort of goes south, everything else seems to follow as well. And then the other way around, at some point, maybe we're in this really risk on environment and then everything can start like comfortably outperform Bitcoin. But in that sense, because that's what I'm hearing at the bank often, oftentimes, people are like, why are you always only talking about Bitcoin and trying to assess the entire crypto sphere where we're at? And I'm like, yeah, maybe I just have to understand if it's a favorable environment for Bitcoin, because then further down the line, it can possibly be a good environment for alts as well. Is this the way you approach it as well? Or do you see that there's even possibilities where like some stuff within the crypto really has its own sort of profile and can walk detached from Bitcoin?
Yeah, this is the $1 million question. I think the way I think of this is, Bitcoin, right now it's about 57% in terms of its market cap of the entire crypto market, and so it's the largest asset. It is the driver of the entire crypto space, and Bitcoin. I think when you think about sort of valuation of Bitcoin, most people have gold in their mind, and so that's sort of like the sort of addressable market for Bitcoin. And that's sort of how we can kind of, there's ways we can get into sort of fair value and how we think about these things. But if you're thinking in terms of addressable market, you're valuing that relative to gold. Everything else in crypto is basically being valued today relative to Bitcoin. And so that's I think mostly what's driving this. We can get into sort of how that could evolve, and we've done a lot of work around smart contract networks and ways to think about valuation. But today, I would say mostly you have Bitcoin, but Bitcoin tends to lead the market. And we do a lot of work around sort of liquidity, not just sort of macroeconomic liquidity and how that impacts Bitcoin, but also how liquidity flows within the crypto ecosystem. And like you mentioned, there are points in these cycles where we tend to have these capital rotations down the risk curve. And maybe we just saw this over the summer months where basically had a rotation into ETH, more liquidity flowing to ETH. ETH starts outperforming Bitcoin. Typically, you'll see sort of a rotation from there to even longer tail assets within the ecosystem. And in terms of like, altcoins in their ability to actually like separate from Bitcoin and just sort of do their own thing, we're starting to see this, right? I mean, I think, if people that were around last cycle, everything sort of just kind of rose together and fell together. And like a lot of, there wasn't a ton of fundamentals like we see today, and new token economic models and ways to sort of separate the wheat from the chaff, so to speak. And so we're seeing this now. We're seeing DeFi protocols. We're seeing other projects that have strong fundamentals. They have some Lindy. They've been around for a long time. And so we're starting to see a lot more dispersion in the market. And I think as these ecosystems mature, we will eventually start to see things sort of separating and trading on their own. For the most part, I would say the crypto ecosystem, Bitcoin as well, is mostly tied to what's happening within NASDAQ. And that's sort of driving a lot of this. And then the liquidity kind of flows within crypto from there. But that's sort of how I'm thinking about it now.
Imagine lowering your tax bill while stacking Bitcoin. With Blockware, you can. Thanks to new tax guidelines, you can write off 100% of your mining hardware costs in a single year. Blockware's mining as a service takes care of everything, so you can start mining Bitcoin effortlessly. Visit mining.blockwaresolutions.com/LNMS and get $100 off for your first miner. Yes, going back to gold, because that's something you mentioned, because obviously if you don't have these valuation metrics, that you can just teleport from the traditional world, onto Bitcoin, people obviously they turn to gold because of the digital gold narrative. But now you sort of just said that this doesn't hold water. If you compare Bitcoin to what gold is usually compared to, like in terms of real rates or the dollar index and stuff, there doesn't seem to be that much of a correlation. Maybe you can explain this as well.
Yeah. So, historically, gold tends to trade with inversely to what's happening with the dollar index. So dollar down, that's good for gold. Gold, similar to Bitcoin, does not have a yield. And so when real interest rates are dropping, capital tends to rotate into gold again because it doesn't have that yield. And I think, we want to sort of assume that framework is going to work for Bitcoin as well, because, we've sort of come up with this idea that that's what this is. This is digital gold. It should trade that way. But when we look at the data, like there are times when it can sort of be correlated to those assets or those metrics, but there are also times where it just kind of separates and does its own thing. And so to me, it sort of meets gold in terms of its hard money, the scarcity of it, and sort of how it's a commodity and how it's tied to energy and the way that it's produced and all of that. But it really does not trade in the same way that gold does. And then you could also sort of look at Bitcoin and actually see how correlated it is to gold itself. And there's not a real strong tie there as well. I think in the last cycle, in 2020, gold was sort of outperforming in the beginning of the year. I think it was up 17% or so, beginning of the year, having a really strong year. Bitcoin was actually doing fairly well, but not separating from gold. And so I think a lot of people are looking at that. We have a similar setup today. Gold is up 39-40% or so year to date. It's outperforming Bitcoin. Are we going to see another rotation? It's certainly possible, but I can't find any sort of concrete evidence that this is we've seen this multiple times. We saw it once in the last cycle. Maybe gold is going to have another catch up here, but when we look at a full set of data, it's hard to find really strong ties to how gold trades as well.
Yeah, I see. I mean, from what I'm hearing, this sounds sort of, for some people, maybe disillusioning, because they've always read Lynn Alden's paper, obviously, on liquidity and how Bitcoin is very much correlated to liquidity. And maybe now what you're saying, there might be not that much to it, or is everyone comparing Bitcoin then also, to the liquidity dynamics, in terms of figuring out how much debasement is actually going the fiat system. Is this the wrong approach, or how would you counter this?
I don't think so. So, I think the thing that I would say Bitcoin is most correlated to is NASDAQ. And then you could say, okay, well, what is NASDAQ most correlated to? NASDAQ is most correlated to global liquidity, right? So then you sort of, there's this narrative that, okay, Bitcoin just trades with global liquidity. And I think you can sort of make that leap. And, there's been, I think Real Vision is probably the one that's done the most work on this in terms of mapping global liquidity to Bitcoin. And there tends to be a slight lag in terms of that correlation. And I think the reason it's holding up is it's the same dynamics that drive NASDAQ are essentially driving Bitcoin. Bitcoin is very correlated to the NASDAQ. And that's kind of how I think of this. And I think a Real Vision actually did an R squared on this. And it was global liquidity was explaining 90% or so of Bitcoin's price action. I think it was even higher for NASDAQ. It was 97% or so. So that's kind of how I think of this is, yes, liquidity is driving all assets is really the framework that I think through. And then it tends to drive other, certain assets, crypto specifically, even more so than maybe a value stock.
In your view, then, is liquidity equals debasement as well, or not necessarily? That's maybe what I'm trying to get at. A lot of people just think more liquidity automatically means more fiat money debasement. But I was just wondering, how do we think about this? Because again, debasement is something, then again, it's all these terms, inflation, and we probably would have to really properly define it. But this is what, again, gold, most people think is correlated to, it's an anti-debasement trade, and now Bitcoin as well. But yeah, it's correlated to liquidity. How do we make sense of this?
Well, there's a lot of different ways to think about liquidity. Michael Howell from, has done a lot of work on this subject. And I think the way that I sort of think about this is there's lots of different sources of liquidity. There's central bank liquidity. There's what we see with interest rates and actually bank lending. Banks can also, by increasing their lending, they can sort of print money. We've seen, sort of this shift in sort of monetary policy where the Treasury is much more involved in sort of managing the currency these days. And that's also driving a lot of this. We have things like the Treasury General account. The Treasury just went through a phase where they were refilling essentially their checking account And so that factors into this. There's the reverse repo market. There's a number of things that factor into this. Even bond market volatility will factor into liquidity conditions. And so it's really adding all of these things up and having a view on sort of what's happening in the macroeconomic landscape to say, oh, does this look good, moving forward? Are we in a bull market? What is sort of the forward-looking setup? And we kind of factor those types of things in, and then we try to always have a view on what Bitcoin's fair value is, to understand, like, is this, is it the right entry point to enter the market?
Yes,
Yep.
exactly.
Yep.
And when you say factor in, these things from macro analysis, is it like that you're actually quantitatively factoring this in, or is it more that it gives you sort of a holistic overview of what's happening? As you said, are we risk on, risk off? And it's not that you're tracking everything so meticulously and then like factor it into your model.
Really, really hard to do. We are working on these types of models. So we basically track about 50 different macroeconomic data points. And we've been doing this for years. And that sort of builds into our sort of investing framework. This, I believe this can be sort of systematized over time, where you can sort of pull, some of these different KPIs together, develop a score for aggregating all of that data. And then, sort of comparing that to past data and how that correlated to Bitcoin's price, and basically, using that as an investment framework. So I do think what all of the data sources, and then that you can get off chain, and then there's a bunch of on chain, data sources that you could then combine with that. That gets really interesting for systematic strategies, quant modeling strategies, and that's a lot of the stuff that we're starting to develop at the DeFi report.
Okay, I see. Well, also quite interesting. Good explanation. I mean, you spoke of the fair value of Bitcoin, and that you're then trying to, maybe once you figured out the macro analysis, everything seems to be as you like, let's put it this way. And
Sure.
then you're like, okay, now I want to figure out the fair value of Bitcoin. And that's, to me at least, again, where I think like stuff like maybe even technical analysis comes in, or then on-chain analysis, where you actually try to go deep. So yeah, how do you assess the fair value of Bitcoin?
Yeah. So I think that the number one thing that, it's sort of a confluence of factors here. But I think one thing that people overlook with Bitcoin is that it is a commodity and it has a production cost. And so, that is an interesting thing to think about in terms of like fair value. And, you can look at historically where Bitcoin tends to trade down to in bear market, and it tends to basically collapse to its production cost, which makes a ton of sense, right? In terms of how it should trade. And so that's one thing where we can monitor, and, there's ways to assess, what are what's the average cost to produce one Bitcoin. We go through a lot of the sort of publicly traded miner, go through their quarterly reports, and a lot of them will report on that. And so you can get a feel for, how much money are miners making, and then where is the price likely to collapse to. So that's one key data point. The other thing is, like, it tends to, in bear markets, we tend to sort of collapse towards the longer term 200-week moving average, which is like a 4-year moving average. And so we like to see, like, if you see that metric actually aligning with the production cost and you're in a bear market, like, now you're putting together a second data point. And then, we look at a lot of on-chain data. What I love about crypto is just the ability to access the data. So all of these networks are transparent. Anybody can audit the data, access the data. Obviously, there's skill required to do that. But we look at a lot of wallet cohorts and sort of what whales are doing. We factor that type of stuff into this. And then, firms like Glassnode have done some fantastic work around sort of understanding sort of the cost basis of the network. This is getting, I would say, a little bit more complex over time as Bitcoin becomes financialized, because you have the ETFs, and that's off-chain data as well. So that now needs to be factored in. But we can get about 80% of Bitcoin's holdings from on-chain data. And we look at, realized price. What do we think the cost basis is of all of the holdings within the Bitcoin network? So I would say those are like the three main things. If you see those three numbers starting to collapse towards the same range, that is a great way to sort of understand, where we could end up in a bear market. And then, of course, when Bitcoin ends up in a bear market, when the crypto industry as a whole sort of goes into a bear market, that usually doesn't happen quietly. So, there's typically over leverage that sort of leads to prices, collapsing. And so we look for that, those are sort of maybe the qualitative aspects of sort of understanding where you're at. But, right now we are, we're sort of, we're not like at like the sort of like we're peak like euphoria valuations, but I would say we're certainly elevated off of what I would call, fair value for Bitcoin.
Discover the power of self-custody with Bitbox, the hardware wallet that combines privacy, precision, and world-class security. Whether you are a beginner or an advanced user, Bitbox offers user-friendly features and advanced options like coin control or optional passphrases. I have personally been using them for years, and so should you. Visit bitbox.swiss.lnms and get 5% off your first order. I see. And how much would you say that, like, as you said, now all these different metrics that you're tracking, I feel like because Bitcoin has a history, that you can also tell things from, like that you work with sort of like standard deviations, where you see, okay, you're sort of even trying to come up with these trading channels, where you say, okay, if it were one standard deviation above this, it has historically only hovered around this for a couple of days, and that's why we can kind of assess as well. It might be overvalued in terms of this metric, and then obviously you look for a confluence, but that's maybe how you work, I guess, with just trying to establish this where it could go into the upper frame, but then also to the lower.
I think that's right. And, I think, like I said at the beginning, this is really something we've come up with, on our own, just just being deeply curious and just really being in the weeds of all this data and trying to solve our own problems. I think a lot of, mistakes people make is trying to get the spreadsheets out and, sort of come up with their assumptions and sort of back it into the same way they look at other things. And like, I think that's the mistake. It's really, you need to kind of look at these things as net new things and come up with your own framework for how they trade.
And how much do you look at like technical indicator as well? Especially maybe now also in terms of if you want to assess stuff in a real short time frame,
Sure.
because like with the fair value, the bottom detecting, it might be on a higher time frame, so to say. But now again, is it like technical analysis that you're looking at maybe right now, with Bitcoin breaking down? Is it also like leverage picture that you're trying to assess here as well?
Yeah. So the way we manage our portfolio, we're mostly, 80% or so in like core assets, which would be more, long term, 2 to 4 years plus or so. We do, allocate towards like longer end of the risk curve. We kind of call it like hot sauce assets, like high beta plays. And, that's where we want to understand sort of more short term what's happening in the market. And for me, that mostly comes down to having a thesis around an asset that typically involves fundamentals and sort of wallet cohort analysis. If we're looking at something like a meme coin or something, we want to understand the holder base of that token. We want to understand the liquidity. And then, if you have a view on some of the stuff that we were just talking about in terms of, are you in a bull market? What's that structure look like? What does leverage in the system look like? If you sort of have a view on some of these things, and then you can just look at the momentum, we look at like RSI, MACD, when you see, something going into like really sold territory because of the sort of like reflexivity and just the way these assets trade, that can be an interesting way to sort of take a small, percentage of your portfolio, maybe into some riskier assets and try to deploy when, like we sort of have seen over the last few days, there was a buildup of leverage and really mostly the altcoin space, just things that were happening on a lot of these decentralized perps exchanges, people getting a little bit out over their skis, getting a little bit complacent. And so we basically just saw that sort of unwind over the last few days. And, you can sort of look at the longer end of the risk curve right now and things are oversold. And so if you have a view on those core assets and maybe there's narrative supporting them, maybe you have a view on the fundamentals and you believe that we are in the bull market structures intact, that's a way to sort of like play that. And the goal is to try to outperform Bitcoin if you're doing putting those types of trades on. So,
And is the bull market still intact, or what is your view into Q4?
my view on sort of this recent sell-off that we've had, I think Bitcoin got up to 124 or so, and we just dropped down. I think maybe got as low as 108 or so. ETH, you know, we've already sort of seen the lot of kind of rotation that we would look for in kind of the year 4 of a cycle where Ethereum started to outperform Bitcoin. A lot of people were front running a lot of these treasury companies, and then we saw capital sort of shift lower into the risk curve after ETH kind of went to its all time high. And I think so. We've been in a period over the summer months of like a lot of speculation, a lot of people, coming into crypto. We've seen Hyperliquid really capturing a lot of mind share, lots of people trading on Hyperliquid. And so we just sort of had a nice little cleanse, I would say. That's sort of how I look at this. I don't think that we have entered some sort of change in the structure of the market. It was really more, I certainly could be wrong about this, but in my view, that was sort of a healthy cleanse. ETH had 480 million of futures long liquidations over the last few days, which was the most. And that's just on the centralized exchange. That's not even factoring in the decentralized, Hyperliquid and Drift and all those. Much more you're actually on the decentralized exchanges. But the last time it had 480 million, futures long liquidations in a kind of a bull market was in April of 21. And that was like on the way to all time highs. It wasn't sort of like after, we had already peaked. So, that's sort of how I'm thinking about it. And, I still think the economic and the macro setup looks good from here. So,
Yes, I tend to agree. I mean, one thing that kind of made me ruminating a little bit was this just announcement, I think, the last 24 hours. And then I don't know if it's really FUD now, that now that Bitcoin is sort of tanking, but that the SEC might potentially investigate some of these stats, that we've seen. And just because I felt like in the last couple of months, with Bitcoin or then other cryptos as well, it was mostly the marginal driver was these stats, these treasury companies. And so have you looked into this at all, or do you think this is just FUD? Or, I mean, if there was some investigation and something bad would come out of this, I mean, it could sort of, harm coming from these stats, right? Or
yeah, no, for sure. And a lot of we've seen just a long tail of these treasury companies. What tends to happen in crypto, probably really in any industry, is capital just ends up flooding sort of the easiest way to make money. We've seen this across almost every new use case for crypto. Somebody comes out with something, it does well, it attracts a lot of attention, and then you get a bunch of copycats. And so when you get lots of copycats and sort of hot money, sort of short-term thinking, chasing things, like you're always going to have bad actors in that. And so it's not surprising to me that we have a number of bad actors. I don't think this is FUD. I think this is real. And, what it looks like is essentially, some of these treasury companies, before they're announcing, their intentions, we're seeing like higher volumes on the stock, right? So that looks pretty suspicious, where it looks like a bunch of people are coming in and buying the stock, a few days before they actually make the announcements. And I think that's what the SEC is looking at. So I think the crypto industry should invite this. This is like a perfect use case for the SEC to come in and clean this up. And like, it'll also, in my view, it's healthy because it separates the good actors from the bad actors, right? The market should have clarity on that, and they all shouldn't just be viewed the same. And so, I don't think it's like disruptive to the like market structure necessarily, but something like, I sort of invite this, to be honest. So,
hey guys, I'm thrilled to share my new book, The Bitcoin Enlightenment, co-authored with Mexican billionaire Ricardo Salinas. Make sure you grab your copy now and learn about how one of the richest people in all of Latin America thinks about Bitcoin. You'll find the link in the show notes. No, yeah, makes a ton of sense. I mean, as much as treasury companies, I like them, not only because they are driving price in that sense, but because I also think it's just furthering the institutionalization of crypto with all these companies at some point having these assets on the balance sheet. They will have to work productively with them, and that's sort of helps the industry as a whole. I guess, yeah, there's also risks to it, and some people have been sort of pointing to these risks, and they might materialize at some point in time, but certainly interesting. I want to move to this next topic, because we talked about Bitcoin having fair value and you can sort of assess this. And then we also established way in the beginning that layer 2 blockchains are like distinctively different because mostly they are built different, like a different structure. They are like the most famous one are proof of stake vis-a-vis proof of work with Bitcoin, and obviously then you have a yield, and I think that what makes it somewhat different. And so maybe if you could share your thoughts on how to fundamentally value layer one blockchains, that would help as well.
Yeah. So the way I think of this is, you kind of separate Bitcoin, like we said, and then you have everything else, and everything else has yield. These are all proof of stake networks, and so different. It's a different framework in my view in terms of where these should go. And like I'll preface this to say that like this is sort of my view on where we're heading. And there is some indications that this framework is actually being expressed in the markets, and we're starting to see a correlation to like this real on-chain yield that I'm going to get into. But for the most part, this is sort of like where I think we're going. And the way that I think of like L1s, the smart contract networks, Ethereum, Solana, the token of that, to me, it should be viewed similar to like a currency within like the framework of a nation state, where the token is the currency, and the nation state, which is the L1, the validators, they collect taxes from users that are accessing those services. And so through that lens, we can kind of start to think about layer ones through the same framework you would think about of how you would value a country, which is expressed through the country's interest rates. And so the way I think of this, like, okay, well, if this is similar to sort of FX and how you think about countries, how do you value a country? And that gets expressed through its currency, right? And so what are the fundamentals that you would look at to assess, whether you want to park your money or buy a country's currency? That is really through, the governance, right? So do they have a strong rule of law, and like you have governance of layer one networks? What is the monetary policy of that government, right? Do they have really high inflation? That would factor into whether or not you're going to, buy that country's assets or buy that currency. And then you have like economic growth. You have like the capital account of that country. How many exports do they have versus import? All of those sort of factors are expressed through a country's real interest rate, right? So that's the actual nominal rate, less inflation, tends to drive carry trade. Countries that have stronger real interest rates tend to be a magnet for capital. And so we can kind of apply that type of framework to layer one. And so, you would kind of assess that similarly, where you have things like token economics, right? That's kind of your monetary policy. How much inflation does the network have? You have things like fundamentals. You have users, you have on-chain fees, you have MEV, you have velocity. Did you want to jump in? Yep.
Yeah, I was just gonna say, like, what is the equivalent of GDP with a blockchain? How do you assess GDP? And then maybe one thing other is like cross-border flows that you have with like regular currencies. And here it might not be cross-border flows, but cross-blockchain flows in terms of like capital flows, one flowing from one blockchain to another, right? So maybe, yeah, GDP, what's the equivalent with blockchains?
Yeah. So, you have these fundamentals. GDP is a great way to think about this. So that would be, the sum of all the fees that the protocols on top of the layer one are earning, right? Just similar to the GDP of a country is the sum of the goods and services produced by the country. So it's the sum of essentially the goods and services produced on that layer one network. You have assets secure is a way you could think about the economy on top of that layer one. You have velocity of assets as well. So that certainly factors in. And then, you mentioned like capital flows, the way that I think about capital flows within, and I think what should drive capital flows in the future is the sort of real on-chain yield, which is the actual user payments that go to token holders via staking. It does not factor in the network inflation, but capital flows to me are driven through, you can sort of assess that through bridging, right? That's one way, is just like how much, what's the value of assets that are, coming into a blockchain versus leaving and going to other blockchains. And so you can just look at that. You can look at staking. So is the layer one attracting capital for staking? Because people want that to access that yield. Something that Solana does very well is asset issuance, right? So native token issuance is driving capital flows because you're issuing assets on Solana. That's driving, it's driving TVL to the chain, and then it's driving velocity of assets as people trade those assets. so native token issuance, I think we're going to start to see a lot more real world assets, tokenized equities, tokenized bonds. That's like another form of capital because capital flows, because when you issue those assets on chain, you're increasing the TVL of the chain. And so those are like the main things. TVL is another way you could just sort of assess that. But that's kind of how I think of it. I think of in the future, what should drive those flows is that real on-chain yield, which is expressed through the fundamentals similar to like a country. Yeah.
In terms of this real on-chain yield, maybe we can dissect this a little further. How can we arrive at this? Where is it coming from again? And then also, is it calculated the same for every layer one blockchain, or are there differences as well?
Yeah, so the real on-chain yield is just simply the amount of the user payments, right? So users accessing on-chain services that flow to token holders via staking. So that's just it's actual user payments through transaction fees, through MEV that accrue to token holders. And we don't factor in inflation for that because we just want to look at the actual economic activity on these chains that flows to token holders. It is the same, across any layer one that has a proof of stake network that has actual transactions, user fees coming onto it, and token holders have the ability to stake and earn those fees. This can be applied, across all L1s. And the reason that we back out the inflation is we want to separate. The inflation to me is more monetary policy, token economics, and that is certainly factors into your analysis. But to just get to the base layer of like the economic activity and how that accrues to token holders, we only want to look at the real on-chain yield. The sort of inflation and how that factors in is a separate analysis that is different from sort of real interest rates because there's no inflation here with the real on-chain yield that you're backing out. You're just simply taking the actual economics. If you're doing this assessment with like a treasury, it's a little bit different because you're backing out the inflation. In crypto, the inflation, if you're staking, is paid directly to you. So it's not diluting you. So I just wanted to make that caveat. It's a little bit different in terms of how people think about real interest rates in traditional finance.
Mm. And in terms of like it being like distributed out to stakers, I think it's not the same across all blockchains, right? Because like the inputs that go into this, I mean, with Ethereum, I guess it's already different than Solana, because or is it the same or yeah.
So in terms of like how that gets paid out to like pro rata to the actual validators and
Yes, in
stakers.
terms of the inputs, for example, like on every blockchain, it's probably MEV, and then obviously it might be different with another chain because there's something else that is an input to the real on-chain yield because the blockchain is sort of maybe a little bit built differently. So if you could talk to this, that would be interesting as well.
Yeah. So, I think the way to think of this is like, okay, you can just look at all the economic activity on these chains. You can compare Solana to Ethereum. But there are sort of nuances to how that actually accrues to you as a token holder. So there are service costs, right? So if you're staking through a DeFi protocol, then you do have to sort of pay a portion of your fee to that. So that can change sort of the yield there. And then just the structure of how the chains are set up is going to impact what actually gets paid out to you. So I think Solana has done a good job of this through Jito. Jito is essentially the execution engine of the entire Solana network. It handles all of the MEV and then disperses that out to token holders. And they're running, I think about 97% of Solana validators run Jito. And so they've kind of created a very interesting setup there where the MEV is sort of pushed out to all token holders. So they're getting transaction fees. They're also getting MEV. This is different on Ethereum because Ethereum has layer twos. Layer twos do not have MEV with a single sequencer. And so there's less MEV on Ethereum. And then you have this sort of bifurcation of sort of where all the economic activity is happening. Some of that can accrue to ETH holders as those transactions are settled down to the layer one.
Yeah.
But the margin for the L2 is like 98%. So there's a different, this is like the nuance of actually comparing the two networks. And I think, the way we think of this is like there's velocity of assets that factors into this as well. That's something that Solana does really well, and that's why their real on-chain yield tends to be higher than Ethereum's. And you can we've done some work to sort of see what the correlation is there between the real on-chain yield and like the SOL price, and it's quite correlated. That is not the case for Ethereum, right? So Ethereum is sort of being driven more by TVL, asset secured, ecosystem GDP, those types of things. And I think this is the difference between Ethereum and Solana, where Solana is much higher velocity of assets. And so that feeds the real on-chain yield, feeds DEX volumes, and that sort of drives the price of SOL. So yeah, there's a lot of nuance here, but what we're trying to get to with real on-chain yield is just real economic activity. And then how is that getting dished out to token holders? Yep.
Yes, because that would have been one of my next questions, in terms of to what extent are these fundamentals like the real on-chain yield then actually driving, the price of a layer one's asset. But yeah, you sort of just hinted at it, that it might not be that case with Ethereum that much, but with Solana maybe a little more. But then it's still hard to maybe just look at this and then derive your like single investment thesis, so to say. It's probably, again, one factor that you can kind of factor in, right?
For sure. It's definitely one factor. And I think, when you see sort of the correlation being a little tighter with Solana in terms of how it trades with the real on-chain yield, it sort of shows you just sort of the difference between how Solana works as a blockchain, how it has really high, it thrives on really high velocity, has much lower TVL than Ethereum does, but it turns over those assets at a much higher rate than Ethereum does. That drives the real on-chain yield. It drives the price of SOL. Ethereum is different. It does not turn over the asset. It's more of like it's more known as like, this is the most secure network. It's been around the longest. It's had, 100% uptime, and it tends to be where people park their asset. And so there's just much more TVL. There's much more stable coins. There's more real world assets on Ethereum, and Ethereum tends to trade more with sort of that metric than it does the real on-chain yield.
And maybe in a far out future, where we have everything on Ethereum, let's suppose this, that at some point, maybe there's also a lot of layer 2 activity going on that then feeds back into the layer 1. This could also start impacting that. Maybe then Ethereum, the asset itself, is maybe more traded based on the real on-chain yield, so to say. That could happen theoretically, right?
I think so. This is all sort of like, living, breathing thing. It's all evolving. And, as these networks mature, and as more like sort of traditional investors come into this and are thinking about these frameworks, I sort of view this as like we're in a period similar to like the 90s when Benjamin Graham was trying to come up with frameworks to value stocks and do relative analysis. And that was kind of the discount cash flow. And so that may be part of the analysis here, but I think we are sort of coming up with whatever the social consensus is going to be in terms of how to do like the relative valuation. That's super exciting to me. So
yeah. Speaking of traditional investors, I mean, in one of your articles, you were also then working this real on-chain yield into a real on-chain yield PE ratio. Maybe if you could quickly explain this, what were you trying to do there? Is this exactly trying to help then that like traditional people can sort of relate to it, but just the inputs are different, sort of?
Yeah, that's really it. So, we get to the I think the report you're referring to is the one we did comparing kind of Solana to Ethereum and the real on-chain yields. And maybe we can link that in the show notes. But what we did there is we can get to what those real on-chain yields are and do that comparison, which is useful. But I think you also want to know what that looks like relative to the market value, the market caps of these networks. And so that's all we're doing with the PE ratio, is just sort of taking that real on-chain yield, annualizing it relative to market cap, and it just gives you a better view of like, okay, this one has a higher on-chain yield. Where is it priced, relative to that and relative to other networks that have higher or lower real on-chain yields? Sort of how we think about that.
Yes, interesting. I have two more things that I'd like to stress here. Some people sometimes also focus on developer activity when they're looking at blockchain, like fundamentally trying to assess them. And then also economic security, in terms of like you mentioned governance, which you have like a good rule of law, but then also maybe economic security in and of itself, which maybe goes again to the tokenomics angle. But yeah, how do you assess these two things, like developer activity and then economic security?
So yeah, developer activity, I would say more important at like the early stages of this. And I think this was one of the things. So Solana in the last cycle had, it was one of the best performing assets of the last cycle. It did have those ties to FTX, and it ended up having a very rough moment after FTX imploded last cycle. And, it didn't really have a ton of fundamentals that you could look at because the ecosystem was really being built out at that time. And so the way to sort of assess, the potential for Solana, I believe at that time, at that precise moment was, are these developers leaving, right? Solana was I think it dropped 97% or so. A lot of VCs were sort of recommending to their teams, hey, you might want to move to Ethereum. Like this thing might not play out. And so the assessment at the time was really, are these developers going to stay here? Because that's the lifeblood of the entire ecosystem. If developers stay, they can build useful things that attract users on chain. They can also attract other developers, attracts more VC capital. And that's sort of the foundation of these blockchains. So I think early stage, extremely important. You cannot bootstrap an ecosystem unless you have a strong developer community that's also like culturally aligned with you and is sort of becoming like evangelists and creating a community around that. So extremely important. I think once you get to, a more mature stage, you just want to see that number continuing to move up because once like a strong developer community is established, not only does that sort of create the things necessary to bring users onto that chain, but it actually creates the standards that are required for more builders to come on. So like with Ethereum, that's, token standards, it's developer tooling, it's sort of all the necessary programming languages, things like this that other developers are going to come into and just sort of adopt those standards. And then that creates an interesting network effect. So yeah, that's kind of how I think of it as like early stage more important, but you need to see, that's something we always look at is like who is attracting the most developers. That is a forward looking metric to keep an eye on for sure.
Yes. And what about economic security? Something, I
Yeah,
guess, this factors into the monetary policy / tokenomic stuff, right?
it's important. I would say it's important that, in my view, it's important that an L1 is sufficiently decentralized. And I think the market tends to sort of maybe not apply enough nuance to this, and where people think that Solana is, more centralized because it costs more to run the validators, and there's just a little bit more barrier to entry to do that. The way I think of this is like, as long as the user assets can, like the native token of the asset cannot be censored, like you can't censor transactions and anybody can run a validator, then you're essentially, sufficiently decentralized. And, this concept of economic security is important in terms of like somebody acquiring enough of the asset to then be able to sort of take control over 51% of the network, and then you're able to censor transactions. So it's important from that perspective. But I think most users, like probably 95% of users today and into the future, maybe it even gets even higher, are going to be interacting with blockchains through an app interface. And, for example, like if you're using stablecoins, you're interacting with Circle's smart contracts or Tether smart contracts, and they can censor you, they can freeze your asset. The blockchain cannot help you, in that situation. So, how important is economic security if you're actually just relying on Circle, right, and trusting Circle? So, this is sort of how I think you want to be sufficiently decentralized, and you want to have enough stake, and the value of that stake needs to be high enough that, somebody can't just like buy up, more than 50% of your token and sort of like take control over the network.
Yes, great.
Yeah.
We've been throwing out a lot of concepts and buzzwords here, but maybe I guess people will like it. So maybe one more thing that I would like to bring up is this net dilution rate. That's also something that I read in one of your articles. Again, this factors or is relevant in terms of monetary policy again with each blockchain, but what is it exactly, and how do we arrive at the net dilution rate for different layer ones?
Yeah, and this applies to you if you're a token holder and you're not staking the asset. So if you're not staking, all of the new issuance that's paid out to validators is diluting you as a token holder. And so this factors into, like you said, the monetary policy, and then, factors into your relative analysis. But the net dilution rate is just the issuance less the burn. So it's essentially the amount of new issuance that's coming out, and then we just annualize that so that you can kind of have a view on sort of what is the sort of token economic policy. How dilutive is that to non-stakers? Again, if you're a staker, maybe you want higher net dilution because that's actually being paid directly to you and you're not being diluted by that. But it's just a way for us to factor in the token economic elements of this into the analysis.
How useful is it as an investor, again, like when fundamentally assessing a project, to think about FTV and like token unlocks and stuff, in terms of trying to assess what's the risk of me being dumped upon, because there's still like this blockchain is rather new, and there's maybe a lot of tokens that are created, but they're still locked up, with some testing schedules. Is this something that you're factoring as well?
Absolutely. Absolutely. This is definitely important. It becomes much more important in bear markets, particularly when there's less sort of flows into the asset. If you know that there's potentially a lot of flows coming out from, VCs that, their vesting periods have ended, or the teams vesting periods have ended, a token can drop 80% or so and still be valued over $1 billion. And that's like, life-changing money for the team and the VCs, and like they're happy to sell it at those levels. So this absolutely factors in. I think what's interesting is we're seeing a lot of new innovative token economic structures, things like Hyperliquid, and other projects that are doing lots of buybacks and trying to sort of like come up with better ways to return value to the token holders themselves. And so, yeah, this is like an important part of sort of the fundamental analysis that goes into, these networks. And we try to avoid stuff that has, more than 50% of the token hasn't been unlocked. It's sitting with VCs. You kind of know what's going to happen when those unlocks start. And so, yeah, it certainly has to factor in.
Yes, great. Very interesting. Well, I mean, maybe one last question, and I know I'm zigzagging here, but you're up to the task. I mean, you brought up meme coins yourself, and this is something obviously at the bank that I'm with, like hands off meme coins. It's like this epitome of or epitome of you can't value them. It's like it's a joke. That's even how Doge started in the first place. But you had also this interesting article where you said, well, you have an approach how you think about meme coins, and there are some metrics that you can look at, like whale retention rates and ratios and stuff like this. Can you maybe, sort of dissect this as well for us?
Yeah. So I used to kind of have this view as well of like meme coins are a joke, and they're sort of like making it harder on people like me that are focused on fundamentals and valuation and try to bring legitimacy to this industry in terms of fundamental analysis. So I used to kind of like be annoyed by Dogecoin. This is like last cycle. I sort of changed my mind this cycle. And it was really just being curious and actually looking at things and looking at the data. And so we came up with some ways to try to understand the holder bases of these various meme coins. We really only look at we call them blue chip meme coins. These are like some of the larger ones that have, a strong holder base. They have plenty of liquidity. They're available to be traded on both DEXs and a lot of centralized exchanges. And so those tend to be able to attract a larger base of capital. But yes, this analysis comes down to analyzing various wallet cohorts, like you said, whale retention rates, things like this, where we look at the number of holders and the percentage of the holder base that has ever had various thresholds in terms of their total token holdings. We mark those wallets so that we can actually monitor that, and then we look at sort of where they're at today in terms of their actual units. So we look for strong numbers there in terms of retention, holding more than 50% or holding more than 75% of your peak units in holdings. And like that gives us conviction that the largest holders of a network also have conviction in the token themselves. And so that's something we look at. We look at, flows. So we look at, DEX flows, and we can do that from various wallet cohorts too. You can look at, you can basically look at whales there as well. What are whales doing? Are they sending lots of tokens into DEXs? Are they sending away from DEXs? And then there's a lot of momentum. These are highly reflexive, highly speculative assets that trade with momentum. And so understanding where you're at with just RSI levels and things like that, looking at MACD and divergence, that's sort of how we analyze them. And, we just kind of have an open mind to it. Like lots of people we don't have to have a view. I don't have to say I love meme coins or I don't love meme coins. I know lots of people care about meme coins. That's all I need to know about. And so it probably pays to pay attention to the space. So
Exactly. That's
yep.
like the quest of an investor, you know, not to be like judgy, but then also like just try to uh, objectively try to assess what's happening here. And I mean, I went through the similar or like through a similar thing as you with meme coins. You know, I was always like, okay, this doesn't make sense. It's net negative for the industry, but it's just a big factor. And I'm yet to see if this will survive. You know, over longer cycle or like if you have a longer cycle perspective. But I'm really curious to see what's happening, and I'll be talking to Murad, I guess, in a couple of
Oh, nice.
days as well, because he's sort of the meme con Jesus, and
Yeah,
I wanna
that's the
wanna get
guy.
his perspective. Yeah.
I'll have to check. I'm interested in checking that out. That's great.
Yeah, no, that's great. Well, I mean, that was great. Michael, thanks a lot for providing all these insights and value. I've learned a lot, especially also from your articles, and that's why I wanted to bring you on. I guess people will like it as well. So, any last words? Where can we send people that they can also learn from you?
Yeah, so I'm pretty active on Twitter. So at Just Do It, JUSTDEAUIT. I'm also active on LinkedIn, and we have a newsletter so people can sign up for the DeFi report. We publish a wide range of topics, mostly in the Bitcoin, Ethereum, Solana ecosystems. And then we also have a paid, $25 a month product where we actually give people access to our portfolios. So yeah, people can check that out.
Sure, that's great.
Yep.
We'll put the links in the show notes. So, thank you, Michael. Enjoy the rest of your day, and hope to talk to you soon in the future again.
Yeah, thank you so much.
Thank you. Bye.